What if the greatest financial disaster in American history wasn't an accident? What if the 1929 stock market crash, the event that wiped out millions of families and plunged the world into the Great Depression, was actually an orchestrated demolition? While newspapers were promising endless prosperity and ordinary people were pouring their life savings into the market, a small elite group of insiders wasn't just quietly heading for the exits. They were lighting the fuse and positioning themselves to collect the profits from the explosion. This isn't a story about a market crash. It's a story of the greatest wealth transfer in modern history. And it exposes a brutal truth about how the world really works. The story everyone knows about Joseph P. Kennedy, patriarch of the famous American dynasty, is almost a comforting fable. The tale goes that he knew it was time to get out of the market when his shoeshine boy started offering him stock tips. It's a great story because it makes him seem relatable, like he was just a savvy guy who saw a clear sign. But the real story is much darker and far more calculated. Let's be real. Kennedy didn't need advice from a shoeshine boy. He understood the system was a house of cards because he was one of its architects. Before his days as a celebrated ambassador and political figure, Kennedy was a master of the Wall Street underworld, notorious for running stock pools. These were essentially legal scams where a group of powerful traders would secretly conspire to buy a stock, inflate its price through manipulated trading, a practice called painting the tape, and then dump it on an unsuspecting public right before it crashed. He knew the game was rigged because he had rigged it himself, time and time again. So in the summer of 1929, when he saw the same manic, uninformed buying from the public that he himself used to exploit, he didn't just see a warning sign. He saw an opportunity. Kennedy didn't just sell his stocks, he quietly liquidated his entire portfolio, converting it to cash and gold. But that wasn't the whole story. He then took that fortune and began to bet against America. He started short-selling stocks on a massive scale, positioning himself to make a killing when the very system that made him rich finally came crashing down. But Kennedy wasn't the only one preparing for the storm. There was another, more mysterious figure operating in the shadows of Wall Street, Jesse Livermore, a man they called the Great Bear. Livermore wasn't an insider in the same way Kennedy was. He didn't have a network of powerful friends in boardrooms and banks. Instead, he had something more potent, an almost supernatural understanding of market psychology. He saw the Roaring Twenties not as an era of prosperity, but as a textbook case of mass hysteria. He once wrote, "The public is always wrong." And in 1929, he decided to bet his entire career on that single belief. Throughout the year, as stock prices hit one dizzying new high after another, Livermore began building an enormous short position. His colleagues thought he was insane. The media called him a traitor for betting against American success. But Livermore ignored them all. He worked in seclusion from a luxurious, heavily fortified office, surrounded by telephones and ticker tapes, meticulously planning his attack. He wasn't just gambling, he was a general planning an ambush, waiting for the enemy to march right into his trap. He understood that once the panic started, it would feed on itself in a vicious cycle of margin calls and forced selling. And when that day came, he would be ready to profit from every single moment of the carnage. While figures like Kennedy and Livermore were making their personal moves, the market itself was sending out secret signals, whispers of doom that only the financial elite could hear. For months, a strange divergence was happening that baffled most observers. While the stock market was soaring to record heights, the bond market, the boring, safe world of government debt, was getting stronger. This made no sense. Normally, money flows out of safe bonds and into risky stocks during a boom. But in late 1929, the opposite was happening. Sophisticated investors, the old money families, and European banks were quietly selling their stocks and pouring the cash into the safety of US government bonds. It was a silent vote of no confidence. At the same time, money from overseas was fleeing America. British and German investors, watching the frenzy from across the Atlantic, knew a bubble when they saw one. They began liquidating their American assets throughout September and October, pulling their capital back home before the inevitable collapse. Perhaps the most damning signal came from the Federal Reserve itself. The central bank had been steadily raising interest rates throughout 1929, making it more expensive to borrow money. To the public, this was just boring financial news. But to insiders, it was a clear message. The Fed was deliberately trying to pop the bubble. They were willing to induce a correction, knowing full well it could spiral out of control, just to purge the wild speculation from the system. The easy money was over, and the people in charge were the ones turning off the spigot. And what happened next would expose a fatal flaw hidden deep within the market's plumbing. The crash of 1929 wasn't just so devastating because stocks were overvalued. It was because the entire system was built on a pyramid of debt. The culprits were new financial inventions called investment trusts. They were sold to the public as a safe way to invest, similar to modern-day mutual funds. But behind the scenes, they were ticking time bombs. Here is how the scheme worked. An investment trust would borrow huge sums of money to buy a portfolio of stocks. But it got worse. They would often use that borrowed money to buy shares in other investment trusts, which were also borrowing money to buy stocks. It was leverage built on top of leverage, a financial Jenga tower where every block was a loan. The smart money understood this perfectly. They knew that as soon as stock prices began to fall, this whole structure would collapse with breathtaking speed. The trust would get margin calls from their lenders, forcing them to sell their best stocks to raise cash. Those sales would drive prices even lower, triggering more margin calls for other trusts, in a death spiral that would become completely unstoppable. The system wasn't just flawed, it was designed to self-destruct. In the final 48 hours before the crash, the secret activity among the elite reached a fever pitch. While the public was still being told to buy the dip, the insiders were engaged in a frantic, coordinated escape. This was their last chance to get out before the doors slammed shut. Corporate executives, the very people running America's biggest companies, were quietly dumping their own personal stock holdings in record volumes. They knew their company's real financial situations, and they could see the economic storm clouds gathering on the horizon. They smiled for the cameras and issued reassuring press releases, then picked up the phone and told their brokers to sell everything. Meanwhile, in the private, smoke-filled dining rooms of Manhattan's most exclusive clubs, the true titans of finance held emergency meetings. These weren't social calls, they were war councils. They shared insider information, discussed which banks were most exposed, which companies were carrying too much debt, and finalized their exit strategies. They used private telegraph lines and fleets of messengers to execute their trades, bypassing the public communication systems that were already beginning to lag under the immense volume. They had a two-tiered system, one for them and one for everyone else. They weren't just guessing about the future, they were creating it, ensuring they would be the ones left standing when the dust settled. Then came Black Tuesday, October 29th, 1929. For millions of Americans, it was a day of pure horror. A day their life savings, their dreams, and their futures evaporated into thin air. But for the insiders, it was not a crash. It was a harvest. As the ticker tapes reported catastrophic losses and panic swept the floor of the New York Stock Exchange, Jesse Livermore sat calmly in his office watching his calculations play out with mathematical precision. As the market plummeted, the value of his short position soared. In a single week, he made over 100 million, the equivalent of more than 1.5 billion in today's money. He had single-handedly profited more from the collapse of America than almost anyone had ever profited from its success. Joseph Kennedy was also counting his winnings. Not only had he protected his entire fortune from the crash, but his short positions paid off handsomely. The money he made from the disaster would become the bedrock of his family's wealth, financing his children's political ambitions and building a dynasty that would shape the 20th century. This wasn't a loss for everyone. It was a brutal, calculated transfer of wealth from the optimistic, uninformed masses to the cold, cynical, and well-connected few. The party was over, and the insiders were the only ones who got paid. But the story doesn't end there. And for the man who profited most from the crash, there was no happy ending. Jesse Livermore, the genius who had outsmarted the entire market, found himself in a battle he couldn't win, the one against himself. Though he had made a legendary fortune, his life after 1929 was a slow, agonizing descent into chaos. He was a master of market cycles, but a slave to his own emotional ones. He lost his massive fortune in subsequent market downturns, got married and divorced multiple times, and battled severe depression. The man who could stare down the financial world with ice in his veins was haunted by personal demons he could never conquer. In 1940, in the cloakroom of a Manhattan hotel, Jesse Livermore, the Great Bear of Wall Street, took his own life. His final note read, "My life has been a failure." He had won the ultimate prize, only to realize it meant nothing. He had mastered the game of money, but had lost the game of life. His tragic end serves as a chilling reminder that profiting from disaster carries its own kind of cost, one that can't be measured in dollars and cents. The Great Crash of 1929 was never just a random event on a historical timeline. It was a lesson, written in the language of greed, fear, and brutal opportunism. It revealed that the market is not a level playing field. It is a complex game where a select few with insider knowledge and psychological discipline can exploit the predictable emotions of the crowd. While millions of ordinary people were ruined by a collapse they were told could never happen, the insiders who saw it coming didn't just survive, they thrived.